The problem arises when you buy the popular international index ETFs, such as those tracking the S&P 500 or a basket of U.S. dividend stocks. With these U.S. focused ETFs, if you make a profit in a general account, you are taxed not only on the dividends but also on the entire capital gain, the difference between your buy and sell price. And that tax is a hefty 15.4% dividend income tax. Let me illustrate just how punishing that 15.4% can be. Imagine you invest 100 million won in a U.S. ETF in a general account and hold it for a few years. You get lucky, and your investment grows by 30 million won. You decide to sell it all for 130 million won. On that 30 million won profit, the National Tax Service will immediately take 15.4% or 462 million won. But the pain doesn't stop there. A much more dangerous trap is waiting: the comprehensive financial income tax. Under Korean tax law, if your annual income from interest and dividends exceeds 20 million won, the excess amount is combined with all your other sources of income, like your national pension or any earnings from a side business. This can trigger a massive tax bomb. In our example, the 30 million won profit is well over that 20 million won threshold. The consequences can be severe. You could immediately lose your status as a dependent for your national health insurance, be forcibly converted to a self-employed contributor, and find yourself paying hundreds of thousands of won more in premiums every single month. This is precisely why we must use the shield provided by an ISA, or individual savings account. The ISA is the ultimate tax-advantaged account, specifically designed by the government to help citizens build wealth. Its biggest advantage is, first, profit and loss aggregation. Let's say within your account, you earn 9 million won on stock A but lose 5 million won on stock B. In a general account, you'd be taxed on the full 9 million won gain, which feels unfair. An ISA, however, combines the two. It subtracts your 5 million won loss from your 9 million won gain, meaning you are only taxed on your net profit of 4 million won. The second benefit is a significant tax exemption. Of that net profit, a standard ISA offers a tax-free allowance of up to 2 million won, while a commoner type account offers up to 4 million won completely tax-free. And for any profits that exceed this tax-free limit, the tax rate isn't 15.4%, it's a much lower 9%. Most importantly, any and all income generated within an ISA, whether from capital gains or dividends, is completely excluded from that dreaded comprehensive financial income tax calculation. It is also excluded from your health insurance premium calculation. You become completely independent from these tax burdens. So, to conclude this point, domestic Korean ETFs are already tax-free on capital gains, so it's a waste of this account's powerful benefits to hold them in an ISA. You should be using every bit of your ISA allowance to hold the assets that are heavily taxed elsewhere, U.S. index ETFs listed in Korea. This is how you extract every drop of value from the ISA's benefits. So, memorize this one rule: U.S. ETFs belong in an ISA. Period. Now that we've solved the tax problem, let's discuss why we should be focusing on U.S. stocks and ETFs in the first place. Some of you might recall that the Korean Kospi market had the best performance in the world during a specific period last year, and you may wonder if it's necessary to look abroad. It's true, our market had a great run for a short time. But we are not investing our retirement funds for just 1 or 2 years. We need to be looking at a 10 or 20-year horizon. When you look at a 10-year chart, the truth becomes clear. The Korean Kospi is incredibly volatile, fluctuating up and down so much that it's earned the nickname Box SPI. Over the last decade, it has averaged a 5.7% annual return, but it has also experienced terrifying drops of as much as -38%. That means your hard-earned money could be nearly cut in half. Could you sleep at night with that kind of risk? In contrast, look at the U.S. S&P 500 or Nasdaq 100 indices. This is where the world's best technology and capital congregate. Over the past 10 years, when measured in Korean won, these indices have steadily trended upwards, averaging nearly 16% annually. Even during downturns, their recovery speed is remarkably fast. In terms of stability, the U.S. market is simply in a different weight class than the domestic market. And now we arrive at the most important point of all. At least half, 50% or more, of your asset portfolio must be in U.S. dollar-denominated assets. Why must we hold dollars? Because the U.S. dollar is the ultimate umbrella in the violent storm of an economic recession. Imagine for a moment that a crisis on the scale of the 1997 IMF bailout or the 2008 global financial crisis strikes again. The Korean stock market would instantly plummet, and your assets would be sliced in half. But a fascinating phenomenon occurs during global crises. People around the world abandon other currencies and flock to the safest money on earth, the U.S. dollar. This causes the dollar's value to skyrocket. The exchange rate, which might have been 1,401 to the dollar, could surge to 1,800 or even 2,001. Now, if you are holding US ETFs, which are dollar assets, even if US stocks fall by, say, 20% during the crisis, the exchange rate might simultaneously jump by 30%. When you convert the value back to Korean won, your account will have either broken even or actually shown a profit. It's an amazing effect. The exchange rate acts as a bulletproof vest, perfectly shielding your retirement funds. To sleep soundly at night, you must hold at least 50% of your assets in the world's reserve currency, the U.S. dollar. If you don't believe me, then simply follow the smartest and wealthiest investor in all of Korea. And who is that? The National Pension Service, NPS. The very fund that will be paying your monthly pension. The people running the NPS are not fools. They manage hundreds of trillions of won for the entire nation. Recent statistics are shocking. As recently as 2002, the NPS had only 0.1% of its assets invested in overseas stocks. But what about now? By 2025, the NPS plans to have a staggering 550 trillion won, or 37.8% of its total assets, invested in foreign stocks. And 70% of that is in U.S. stocks. It's not just stocks. When you include foreign bonds and alternative investments like real estate, nearly 60% of the entire National Pension Service Fund has escaped Korea and is invested in foreign, primarily dollar-denominated assets. Why would they do this? Because the NPS learned a painful lesson. In 2021, the Kospi hit a record high of 3,300. At the time, the NPS held a large 20% position in domestic stocks. The fundamental rule of investing is to buy low and sell high, so they should have sold and realized their profits. But what happened? There was a massive public outcry. People protested, saying, "The NPS is selling and crashing our market. They must not sell." Forced by public pressure, they failed to sell at the right time. Subsequently, the Kospi crashed, and the NPS was left holding the bag, absorbing tens of trillions of won in losses. They learned firsthand that if they keep the nation's money trapped in the small, volatile Korean market, they cannot guarantee the people's retirement. That is why they are so aggressively raising their U.S. dollar asset allocation to 60%. My friends, it's time to stand on the shoulders of giants. If the NPS is moving 60% of its assets overseas, it is an incredibly risky gamble for you to be 100% invested in Korean stocks and real estate. So, with that settled, what specific ETFs should you hold in your ISA? For those of you who are tired of watching stock prices fluctuate and simply want a steady stream of cash that beats bank interest, I have a solution. For our 50s and 60s audience who dislike volatility, I will recommend just two clean and simple U.S. dividend ETFs that can build a stable and significant cash flow. First recommendation, please take note, the Codex US Dividend Premium Covered Call Active ETF, ticker 441640. This product is the Korean version of a very famous U.S. fund known for its high dividends, DIVO. It holds a mix of incredibly strong blue-chip tech stocks like Microsoft and Apple, along with stable financial stocks. Its most remarkable feature is its use of a covered call strategy, a somewhat complex but safe derivatives technique, to generate monthly distributions. Recently, its annual dividend yield has been in the high 9% range, approaching 10%. Furthermore, this ETF has tremendous defensive strength in a falling market. Over a recent 6-month period when other dividend ETFs were in the red, this fund alone held strong, posting a 1.6% gain. For those who want a stable 9% yield combined with capital preservation, this is my top recommendation. My second recommendation is from KB Asset Management, the sole US dividend top 100 daily fixed covered call ETF, ticker 479060. This fund holds a basket of 100 high-quality U.S. dividend stocks and uses a cutting-edge daily covered call technique, selling options every single day to generate income. The most prominent feature of this product is its absolutely massive dividend yield, which has recently been in the 15% to 17% per year range. This means if you invest 100 million won, you can expect to receive over 15 million won a year, or more than 2 million won deposited into your account every month, just like interest. For those of you who don't care much about stock price appreciation and just want a generous, reliable cash flow to cover living expenses or spoil your grandchildren, this sole ETF will be a true blessing. If you simply split your investment 50/50 between the Codex product and the Sol product, they will complement each other perfectly, allowing you to build a truly peaceful and prosperous retirement dividend farm. And of course, you must buy them within your tax-sheltered ISA to ensure you don't give back 15.4% of that income in taxes. Let's cement today's key lessons in your mind, because you need to take action today. The answers are clear. First, open your brokerage app on your smartphone and create a brokerage-type ISA right now. Then move all the US ETFs you bought in your general account over to it. You will be liberated from the fear of the comprehensive income tax and will benefit from the 4 million won tax-free allowance and the low 9% tax rate. Second, allocate at least 50% of your total financial assets to US dollar assets, namely US ETFs. Even the National Pension Service has moved 60% of its assets to safety overseas. The rising exchange rate during a crisis will protect your retirement funds. Third, if you're exhausted by the volatility of the Kospi, stop stressing. Buy the 2 high dividend ETFs I recommended, Codex US Dividend Premium Covered Call Active and Sol US Dividend Top 100 Daily Fixed Covered Call, in a 50/50 split, and let them work for you. A dependable cash flow of 8 to 9% or more per year will enrich your life every single month. Retirement is not an end, it is the beginning of a new life. In capitalism, the ultimate winners are those who minimize their taxes and use the US dollar as their shield. If today's video has helped you protect your wealth, please be sure to subscribe and like this video. An encouraging comment also gives me great strength. Finally, I have one favor to ask. Whether you have had successes or failures with ETF investing, please share your valuable experiences in the comments. For all of us to succeed together, it is crucial that we learn from one another. Thank you. Today's conclusion is simple, with just 2 key takeaways. First, you need to immediately move any US ETFs from your standard brokerage account into a tax-advantaged individual savings account, ISA. Second, stop stressing over the daily ups and downs of the stock market. Instead, shift your focus to just 2 specific US dividend ETFs that offer a high annual yield of around 8%. If you can firmly grasp these 2 points today, you'll be on the right path. My career began with hands-on experience at a domestic bank in Korea, which I then built upon with practical investment experience on Wall Street and at a global financial services firm in New York. For the past 20 years, I have been teaching finance and economics at the university level. This message is especially for those of you in your 50s and 60s, who are either approaching or have already entered retirement. You've worked tirelessly your entire lives to accumulate your precious assets. But with bank interest rates being so disappointingly low, I know many of you have recently opened brokerage accounts to seek better returns. You've likely seen the news and YouTube videos proclaiming that South stocks are the place to be. You've heard about the S&P 500 and the Nasdaq, and perhaps you've started using apps like Kakao Pay or Toss to regularly buy small amounts of US index ETFs listed on the Korean market. But let me ask a critical question. Are you holding these investments in a general brokerage account? If so, you are essentially pouring water into a leaky bucket. Why? The reason is taxes, staggering, wealth-draining taxes. When you buy a domestic index ETF, like one tracking the Kospi 200, in a general account, you pay zero tax on any capital gains when you sell. It's completely tax-free, which is fantastic. You only pay a 15.4% tax on the distributions, or dividends, you receive. So far, so good.